In this week's video, we'll review the latest charts and a wide range of historical data to help us answer the question, are earnings about to fall off a cliff in a 2008-like manner, taking stocks with them? We've got a lot to cover, so feel free to use the pause button on your video player. We'll do a quick recap of the first 3 bullet points since we've covered these topics in the past, and focus the majority of our time and effort on this bullet point, and this bullet point here. As we covered earlier this month, in recent weeks we've seen some significant and observable improvement and covered numerous charts and data sets that hint at the possibility of a significant shift in asset class leadership going forward. Thus, if things are improving, it's logical to ask, do recent economic trends align with or contradict the charts that have been improving in recent weeks? One of the toss and turn issues for investors early in 2023 is the fact that we have a lot of data in the rearview mirror, primarily in the form of the yield curve and multiple hikes from the Fed, that tell us we should be concerned about a recession in 2023. And as we've covered numerous times, if we go into a recession, typically that is not a good thing for earnings. These are economic recessions here dating back to 1957. If we take out the 2 worst cases, dot-com bust bear market and the financial crisis, even removing those cases, earnings declined on average by about 19%. And some simple math says if earnings decline by approximately 19%, the S&P 500 realistically could trade somewhere between 2,800-ish and 3,200-ish. But the key term associated with all of this data on the left side of your screen is recession. Thus, common sense tells us if we were going to enter recession in 2023 and earnings were about to get whacked, which may or may not be the case, we would expect to see some weakening economic trends. And as we walk through the data, it's good to keep in mind that the economist that identified the yield curve as being a useful tool to potentially predict recessions is saying he believes that the yield curve could be giving a false signal in 2022 and 2023. Here's a recent quote from that economist. "I have reasons to believe, however, that it is flashing a false signal." Thus, if the economist that identified the yield curve as being a useful tool is saying he's not that concerned about it, a logical next step is to look at the data, current economic data within the context of history, and see how vulnerable we are walking forward. As we've covered it in the past, these are the 6 data sets here that NBER leans on to declare a recession. In their definition of a recession involves a significant decline in economic activity that is spread across the economy, meaning multiple sectors, more than just tech, and lasts more than a few months. So let's walk through these data sets from a historical perspective. What did these data sets look like in the past during economic recessions, and how does that compare to the present day? Real personal income excluding current transfer receipts. So real means adjusted for inflation, and for the most part, this means excluding government payments. And if you know your market history, you know we had a horrible bear market in 1973 and 1974, very, very similar to the dot-com bust or the financial crisis. And you can see this data set was extremely weak for an extended period of time. Observable evidence. Similar situation here, the 1980 double dip scenarios. We peak here, we're weak for quite some time, and then we have a little bit of weakness here that doesn't look too bad. But the trend from point A here to point B is down. Trend from point A to point B is clearly down. Significant drop in the 1990 recession. Dot-com bust bear market. Look how long we're below this point here. We go all the way out to 2002, and we're really nowhere near this peak here in 2001. The shaded areas are the recessionary periods. Financial crisis, very, very easy to see the significant decline. Right here in the definition, significant decline. And it can be helpful to look at the significant decline during the COVID plunge here in economic data and compare it to where we are. This is the latest data that we have. This data was taken and downloaded on Thursday of this week. Had some weakness in the rearview mirror, but we've bounced back, and that's one of the reasons why James Bullard has said recently that the probability of a soft landing has improved quite a bit in recent months. Current data set sits near an all-time high. Employment, total non-farm payrolls. This is the monthly labor report. Trend down. Trend is down. The 1940s. 1950s, you can see there's a clear shift. Weakness from point A to point B, weakness from point A to point B. It came late in this case, but eventually there was a significant and observable downturn. No mistaking the weakness here. An observable shift, an observable decline. Look at the trend from point A here to point B down here. This is your elevator shaft or roller coaster look here in the financial crisis. Here's the COVID plunge, and this is the data that we have in early 2023. Chart speaks for itself. And common sense tells us, how do earnings eventually take a hit? Well, people lose their jobs and they stop spending. It's not really what we have in the present day. So we just reviewed non-farm payroll. Now let's take a look at another data set related to the labor market, employment as measured by the household survey. Discernible drops during recessions. Get a big plunge here from point A to point B. It comes late, but it's very discernible. From a trend perspective, late 1979, we really don't make any progress all the way out into 1983. This is your Baskin-Robbins double dip. A discernible shift between point A and point B. This data starts to deteriorate well before Lehman Brothers. And as you can see, the COVID plunge doesn't look anything like the last set of data that we have from 2022. Keep in mind, it's early 2023. For the most part, we're still looking at data from Q4 of 2022. Key takeaway is significant decline. Significant decline. Pretty easy to see. If we look at the last year, the trend here is up. This is the household survey. Same can be said if we go back to total non-farm payrolls. The one-year trend unequivocally, clearly remains up. Is it possible that this is about to shift significantly? Absolutely, positively, yes. But that's something that may happen. We're reviewing the facts that we have in hand today. Real personal consumption expenditures, data set is limited. We have a clear decline from A to B in the financial crisis. Clear decline, COVID. This is the present day chart here. Why are we looking at these data sets? Because these are the data sets that NBER tells us they focus on to determine whether or not we're in a recession. Real manufacturing and trade industry sales. Point A to point B. It's the 1973-74 bear market, and you can see here, late in 1973, this data starts to fall off the table. Double dip, point A to point B. Clear and observable evidence in 1990-91. There's a big drop here from point A in September of 2000 down to September of 2001. Again, well before Lehman. This is in late 2007 back here. This is a significant decline. And magnitude can trump duration in terms of declaring a recession. And it's also possible in this case that duration will trump magnitude. That's NBER's call. But it's difficult to look at this data set in the present day and say this represents a significant decline. Industrial production, this is a significant decline. 1973-74 bear market. The decline starts in 1973. The data starts to fall well before the recession. Well before Lehman here. This is late 2007. And yes, we've had some weakness in the present day, but we had weakness here. This wasn't declared a recession. The duration here is much longer than what we have in the present day. So we want to compare this look here to this look in here and this look in here. So let's dig a little deeper and focus on the primary question. We just covered all this data, and it's fair to say if we review it objectively within a historical context, it really doesn't look that bad. In fact, it looks quite good. Well, let's look at this theory here from Morgan Stanley. This article is dated December 20th of 2022, so it's about a month old. We often hear from clients that everyone knows that earnings are too high next year, meaning the estimates, and therefore the market has already priced it in. However, we recall hearing similar things in August 2008 when the spread between our earnings model and the street consensus was just as wide. Thus, Morgan Stanley is saying it's possible that people are extremely complacent about earnings just as they were in August of 2008. And in this case, they really did fall off the table or fall off a cliff. Thus, the million-dollar question is, how concerned should we be about that type of scenario, a 2008 type scenario, August of 2008? So, does January of 2023 look eerily similar to August of 2008? We're looking at the same data sets that we just covered. August of 2007 to August of 2008, approximately a year. Same data set looking back a year. In terms of the current trend, this is on the verge of making a new all-time high. August 2007 to August of 2008. It's not shocking that earnings fell off the table walking forward from August of 2008. There were a ton of people losing their jobs. How does the same data set look today if we look back 1 year? This is a 1 year look back period. This is a 1 year look back period. August of 2007 to August of 2008. Same data today. Real personal consumption expenditures. August of 2007 to August of 2008. Same data today, looking back 1 year. Real manufacturing and trade industry sales, August of 2007 to August of 2008. It's a pretty clear trend. Not great in the present day, but better than the previous data set. Industrial production, August of 07 to August of 08. Some weakness in the present day, but we have to keep in mind, what matters here are trends. NBER's definition emphasizes that a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. This portion here, lasts more than a few months, speaks to trends. Is the trend down? Is the trend up? Or for the most part, has the data been moving sideways? And if we compare August of 2008 to the present day in that context, side by side, we can learn quite a bit about probabilities in the present day relative to probabilities in August of 2008. If we want to compare trends, 1 year trends, a good way to do that is a point-to-point slope. So this is the data set a year ago. This is forward 1 year. So we'll do that on all of these charts. Look at the slope of this line relative to the slope of this line. This is a 1 year look back, August of 2008. This is a 1 year look back with the latest data that we have in hand in January of 2023. And we'll look at all of the data sets in the same manner. Non-farm payrolls, point to point. Not an exaggeration to say that this data set and this data set, for the most part, are polar opposites. This trend is clearly down, and this trend is clearly up. The non-farm payrolls, the monthly report, labor market using the household survey. Significant difference in the 1 year look backs. Real personal consumption expenditures, point to point, August of 2008, January of 2023. Real manufacturing and trade industry sales. Notice this chart over here doesn't look that great, but if we look at it from a trend perspective, the data today is higher than it was a year ago. Point to point, the trend looking back 1 year is slightly up. Not the case here in August of 2008. It is clearly and unequivocally down. Industrial production, some weakness here? Yes, some weakness. But looking back a year, it still looks quite a bit better than August of 2008. Let's make this assumption. Let's assume in 2023 we are going to experience something similar to calendar year 2008, meaning we're going to go into a recession and earnings are going to fall off a cliff. Under that scenario, and if you objectively look at the data that we just covered, it's really not fair to say the present day looks like August of 2008. We really don't look anything like August of 2008. It is possible that we look similar to maybe January of 2008. But what does that mean? That means walking forward, we need to see significant deterioration in these data sets. And that may happen. And it may happen very, very soon, but it hasn't happened yet. We're not using this data to predict anything about the future. We're trying to assess present day probabilities based on the data that we have in hand today. What are the odds that market participants are underestimating how weak the economy is today relative to August of 2008? In terms of broad economic data, the present day really doesn't look a lot like August of 2008. That doesn't mean earnings aren't going to take a hit in 2023. It just says the odds of the present day being very, very similar to August of 2008 are not particularly high right now. Let's quickly talk about the debt ceiling. If you haven't heard it already, you will probably hear that we should be concerned that 2023 is going to be similar to the debt ceiling crisis in 2011, and in this case, the S&P 500 in 2011 tanked. Now, let's assume the market's primary concern in 2011 was the debt ceiling crisis in the U.S., meaning the market thought there was a realistic probability that the U.S. government was going to default on its debt. That would mean once this crisis was resolved, probably should have seen a V-bottom in stocks. If that's what you're concerned about, when it gets cleared up, things should get better. The debt ceiling crisis in 2011 was resolved on Sunday, July 31st, 2011, headline from the New York Times. Thus, we would expect that the stock market should have turned around following Monday morning. And if the market was really concerned about the U.S. defaulting on its debt, simple logic tells us the last thing you would want to own heading into this issue, so up until July 31st, would have been U.S. Treasury bonds. Why would you want to own something or buy something that you believed was about to default? If it defaults, you don't get paid back. So if the market was concerned about a long-term problem with the U.S. default, we would expect TLT and IEF leading up to July 31st should be tanking. Remember, this is a Sunday. That was not the case at all. From February 10th, 2011, so leading up to the debt ceiling crisis, TLT between February 10th, 2011 and July 29th, 2011, so a few days before it was resolved, TLT gained 13.13%. Now, that doesn't look like a market that's concerned about this topic. In fact, that wasn't the main concern. This was the main concern. The European debt crisis. So leading up to July 31st, 2011, from February, the previous Friday, TLT gained 13%, IEF gained 10%. And look what the stock market's doing. This is SPY here. It's not doing well. The reason why TLT and IEF did extremely well leading up to this date here is the market was concerned about sovereign debt or government debt in Europe. New York Times, stocks plunge on fears of global turmoil. So this is August 4th, well after July 31st. September 16th, 2011, Euro debt crisis, no solution in sight. It is logical that if you felt debt in Europe was risky, that you would buy U.S. government debt, which is exactly what happened. You can see the trend in TLT and IEF leading up to this date is very, very strong. The trend in the stock market is getting weaker and weaker. August 4th, after this, SPY is plunging, and it doesn't bottom until early October. And from February of 2011 to early October 2011, so October 3rd, TLT was up over 42%. The point-to-point movement, 44.32%. Doesn't sound like a market that's concerned about the U.S. defaulting on their debt. Is this an issue we should watch? Yes. Could it cause some volatility? Absolutely, positively, yes. But what are the odds that any politician is going to let the U.S. default on their watch? It's not very good. Why? Because it would be very, very difficult to get reelected if you were responsible for sparking that type of crisis. What we're seeing here is the attempt to use the deadline as political leverage. The odds are extremely high that some last-minute deal will come together. Could it be a big problem? Sure, it could be. The odds are never zero. How about the charts? Acknowledged improvement here on January 4th via this tweet and covered it in the January 6th video. And in that video, we showed charts of emerging market bonds down here and emerging market stocks here. Let's review this chart. This is global stocks, ex-USA. So think foreign stocks, everything around the globe with the exception of the United States, relative to U.S. Treasury bonds. This can help us with several questions. We just showed that present-day economic data looks quite a bit better than the economic data, especially looking back a year from August of 2008. How about the charts? So early in 2008, price here, stocks versus bonds, below the moving averages, and the slopes of the moving averages are down. By the time you get to August of 2008 and into the Lehman period, stocks have been waving yellow flags for quite some time. So just as we compared the economic data to August of 2008, let's compare this look to the present day. And once again, it's probably fair to say the present day over here, price, this is price, the top line, above all of the moving averages. Slopes of the faster moving averages are turning up. And we made a stand here at the 50-month moving average. From a factual perspective, the present day looks a lot better than really any period in 2008. And if we look at this period here, it really looks more like these constructive periods. This is 2012. Price right here gets above the 50-month moving average. Faster moving averages, the 12 and the 8-month here, are turning up. This is an improving look here. Eventually, price late 2016, early 2017 gets above all of the moving averages. Slopes are turning up. If you know your market history, the S&P 500 bottoms right here. Global stocks, in this case, are laggards. The S&P 500 bottoms in October of 2011. This is also a lagging look for the most part. When the momentum turns here for global stocks relative to U.S. Treasury bonds, you can see the cross takes place below the zero line. Similar situation here. Cross takes place below the zero line. Present day looks quite a bit better. Momentum is turning up from above the zero line, and the market held at the 50-month moving average. Not the case here. We were below the 50-month. Not the case here when we bottom in 2016. We're well below the 50-month moving average. Not the case at the COVID low. Momentum turning up, and you're also turning up from a much stronger look in terms of the long-term trend here. This looks better than this. This looks better than this. And this looks better than this. And in these instances, good things happened in the stock market. Stocks in the U.S. didn't peak until 2015. And in this case, we get this turn in early 2016. The S&P 500 really doesn't start to get volatile until January of 2018. And this is an improving look here, and the market does extremely well until really early 2021. So this is an improving risk appetite look. This is an improving risk appetite look. This is an improving risk appetite look. And this is an improving risk appetite look. This chart, January 20th, Friday, January 20th at 10 a.m. Eastern Time. Does this look like a market that's terrified of a global earnings recession? It's hard to say yes. In fact, you can make an argument that this chart is more optimistic than it's been at any point here. Here's the ratio here. We're above that level today. Here's the ratio here. We're above it today. Here's the ratio in 2018. We're above that level in the present day. And here's the ratio in the present day. It's very, very close to this level here. The difference is momentum is running out of steam here. It's running out of steam here. And it starts to run out of steam here. The present day momentum is trying to turn up and improve now. So this look here would be similar to this point here. This look here would be similar to this point here, potentially. And this is even better because momentum is turning from above the zero line. Doesn't predict anything. It just speaks to probabilities. But this looks quite a bit better than this. So let's look at price here again and compare it to this point, and this point. Momentum turning up, momentum turning up, momentum turning up, up, trying to turn up in the present day. And in terms of the ratio's position relative to the important 50-month moving average in blue, we bounced right on the 50-month here. This rally starts well below the 50-month. This rally starts well below the 50-month. And this rally starts well below the 50-month. What does that tell us potentially? That these shifts that we've been talking about, it aligns with that theory. What shifts? For the most part, during this period in here, U.S. stocks trounced foreign stocks. And for the most part, in this period here, especially walking forward from 2016, but even from point A to point B, your clear leaders for the most part in the U.S. are technology stocks and growth stocks. So we're in this period here where SPY, XLK, and VUG all do well from point A to point B. And the rally starting from this lagging look below the 50-month, starting from below the 50, from below the 50, these all look similar. And in this period here, the leadership for the most part stays constant. This is telling us that it's possible we're seeing a shift where U.S. stocks may also have bottomed here, but they might lag their foreign counterparts going forward. And rather than being a leader, technology may be in the process of bottoming, but it's possible that tech and growth from a longer-term perspective could now be laggards. That doesn't mean they're going to lose money. Everything bottoms here. Everything bottoms here. Everything bottoms here. It's just the U.S. outperforms, the U.S. outperforms, and the U.S. outperforms. That may be getting ready to change and may be in the process of changing. If we just look at global stocks in isolation, good look here as well. Compare the bottoming process relative to the 50-month. Bottoming process, bottoming process. Probably fair to say this and this looks similar to that process from risk off to risk on 2011, 2012, the bottoming process in early 2016, and the COVID low. In each case, monthly RSI tries to get above 50, eventually gets above 50, eventually gets above 50. Currently, this is January 20th, 2023 at 10:02 a.m. Eastern Time. Monthly RSI is above 50, and momentum down here, the Kopic curve, is trying to turn up in a constructive manner. Also noteworthy, resistance, resistance. Back above that level in the present day. This look here, a higher high here relative to this high and this high, and the fact that we're able to clear this and this really doesn't look like a market that's overly concerned about a global recession and or an earnings tank in the present day. Anchored volume weighted average price for the equal weight S&P 500 RSP in the ETF world. This is a decline this week. We've held thus far near a very logical area. On a wide range of charts, bearish probabilities would improve considerably if price gets into this area here, and the longer it stays there, the more concerning it would become. Thus far, the look in front of us says the attempt to form a base from the June low to the October low, that attempt is still alive and well at this point. We had to sum up some of the recent shifts relative to the Fed. The Fed is now less bad. And even if they stick with their current plan, they've basically telegraphed that within a matter of months, their base case is that they will pause. Everything we've talked about in this week's video speaks to attempts to flip the trend. S&P 500 weekly, 1 p.m. on January 20th. The attempt to flip the weekly trend would take a big step if we can get a weekly close above this level here or above 4072. That may happen soon. It hasn't happened yet. Still in a downtrend. And that is reflected in our balanced allocation. Another incremental shift in the Fed here. There's a little bit more about this on our Twitter feed. This comment here from Esther George right here ties in nicely with this topic from last week's video. The S&P still has work to do. A weekly chart of foreign stocks, so this is all world ex-USA relative to SPY, looks like it has already turned the corner. The longer it holds a look like this, the more relevant it becomes. Foreign stocks have had a great run. It is possible, even if good things happen, that they are very extended and overbought in the short run. Have to have realistic expectations about what the next few sessions or weeks or even next couple of months might look like, even if good things happen. Right now, this is a constructive look. January 20th, 1 p.m. Eastern. Like the S&P 500, still in a longer-term downtrend with hurdles to clear. Realistic expectations. Momentum does have a constructive look. The present day here doesn't mean we would necessarily blow through this line even if good things happen. Remember we said the S&P 500, we'd like to see a weekly close above 4072. We could spend 2 hours showing weekly cloud charts that are near possible resistance. So foreign stocks did beat SPY this week. VEU was up 0.82% for the full week. SPY was down 0.66%. Q4 of last year, we could not check one of these bullish boxes. Now we can check 3 of them, but there's still work to do. This area here on a ton of charts represents potential or possible resistance. If we can get to the other side, the longer we stay there, the more relevant it would become. It also would be relevant if the lagging span green can get to the other side and blue and red can get to the other side along with price. That may happen, but right now the default is that this is possible or potential resistance until proven otherwise. For clients, we have charts marked up like this for every single position. And we have charts like this on multiple time frames marked up for things we're considering to add to our portfolio. And we're not making any assumptions about what next week or the next few months look like. It's very unwise, given the data that we have in front of us today, to close mental and emotional doors to the bearish case. Why? Because if things don't pan out in the short to intermediate term for the bulls, and you close those doors, it's going to be very, very difficult to manage risk properly if risk needs to be managed. As noted on Twitter, the December lows, really on any chart, are very, very important. The bears would love to see the December lows taken out. Our current allocations reflect the improvement that we've seen, no question. The appetite for risk has improved significantly in recent weeks, but as shown in this week's video, there's still hurdles to clear, and there's still work to do. Thus, it's extremely important to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.